Welcome to ANG Digest, where we bring you the latest insights and expert opinions on all things mortgage related. I'm your host, Nikita Verindab, and today we'll be discussing a range of important topics that I'm sure to interest our audience. Today we have two special guests, Alex Suslov, the head of capital markets, and Hanna Roslyk, Correspondent Business Development. Alex will discuss mortgage securitization and its impact on interest rates, while Hanna will explore how mortgage brokers can transition into becoming lenders. Get ready for an insightful discussion on these important topics in the mortgage. Hanna, Alex, welcome to the studio. It's always a pleasure having such an amazing guest here. Thank you so much.
Thank you for having us.
Happy to be here as always. Great filming this with Hanna. I think there will be a lot of good stuff about corresponding business, corresponding lending, and what ANG does in that space.
Right. I definitely agree with that. You have no idea how hard it was to convince actually Hanna to join us here. And finally, she's here.
Finally, guys, let's start conversation.
Should we dive straight to the questions? Alex, you ready?
Absolutely.
As always, I'm not surprised. So what are the main benefits of securitization in financial markets?
That's a very great question, I'd say. There are several benefits from the securitization market in general. The main thing I'd say for the public and for the society in general, securitization market allows to provide a more affordable financing. Because with securitization, what lenders do, they basically finance at a lower rate. They basically finance those loans that they provided to people at a lower level via securitization vehicles, meaning they offer those loans in a more diversified package. They take thousands of loans and refinance them to larger investors like pension funds, firefighters funds, whatever, large institutional investors. Finance at a lower rate due to the fact that there is more diversification. So overall, that allows to provide better rates to US people. This is number one. And if you're talking about securitization as a method of execution loans for a mortgage company, for a fund, that means that you have your own program and you're not that dependent, I would say, to other buyers on the market. You kind of create the program, of course, meeting certain standards of origination, but you're more flexible.
Right. So to make it more simple for the viewers, can you provide examples of securitized assets and their impact on interest rates?
Absolutely. What we do in the mortgage space is called residential mortgage-backed securities. What happens, non-KM loans are being pooled into 400, 500 million pools. There are thousands of loans in there, and bonds are created, thus offered to the public, and institutional buyers may purchase those bonds from the issuers, thus kind of financing those originations that mortgage company creates.
Right. What role actually do credit ratings play in securitization transactions?
I'd say paramount role. What rating agencies do is they basically review the loans, they review the transactions, and give like a third-party trusted opinion to the investors who purchases those loans. So basically, rating agencies, they say either your bonds are good or bad, put it simple. Same they do with US treasuries, with US debt. They may say that if credit rating of US treasury drops, that means the overall situation in the US economy drops. Same for a single transaction. They say, what is the effect of, what is the odds that the deal would default? And that all depends on the credit parameters. Basically, in this way, rating agencies create a certain standard for underwriting. And also to add to the different underwriting standards of the lenders, I think Hanna would add to it as well, because she works with different lenders and people have different underwriting guidelines that all is basically created by the market and by the that securitization demand, and what rating agencies are kind of guiding different lenders too. So when we buy loans from other lenders, there are some different guides, and Hanna can speak in more details to it, as she's dealing with it on a day-to-day basis.
Right. Hanna, do you agree with that?
Yeah, let's discuss it a little bit more.
Well, before we're going to discuss it, could you please actually tell us what you do, what's your position, what department are you in?
So I work in sales. I'm Correspondent Business Development. So I work with different lenders that is out there that is trying to sell some loans to investors, to mortgage investors. And my job is to find them and to work with them, to help them out with our system, process, and our products.
Hanna, question's going to be super easy. I'm pretty sure you're going to answer them without even thinking about the actual question. So let's start. You ready?
Yeah, let's go.
As usual, right? Can you explain the distinctions between a broker and a lender in terms of their roles and responsibilities?
So mortgage broker represents the sales side of the mortgage application. Their responsibility is to find the borrower, the client, and then figure out what's the best product that's going to suit for this borrower, what is the best rate, and find lenders such as A&D Mortgage, and bring the borrower to this lender. And then already once the mortgage application process starts, their job is to help out borrower to work with underwriter and provide documentation that underwriter may request. Regarding the mortgage lenders, they are financial institutions or banks who are responsible for funding the loan, so bringing money to the table and closing the transaction. Their responsibilities include evaluate borrower's creditworthiness, issue disclosures, federal, state required disclosures, and actually provide the funding at the closing table.
Wow. All right. I'm pretty sure you're that confident when you're talking to the investors and telling them actually bring us money, right?
Yes, we are the investor.
Second question. What are the various types of channels that Correspondent Business actually offer?
So we here at A&D, we offer 3 different channels, depending on how big your company and how much responsibility you are as a correspondent lender wanted to take on. First one is mini correspondent channel. It's very similar to the wholesale, to the mortgage broker business. It's pretty much the same process. So your investor is taking on mortgage operation side of the business, but the lender is responsible for funding the deal because all the loan documentation is done under their website, under their name. And they need to provide funding for the mortgage itself. The second channel is non-delegated. That's where, again, correspondent lender brings on client, work with the client. All the transaction is done under their name. They're disclosing the file, closing, funding it, but investor underwrites it because there's a lot of investors. Sometimes some of them have different guidelines. Mm-hmm. So it's very important for the lender to underwrite the file, and they don't want to take on this responsibility. So they're putting it on the investor. That's non-delegated business. And then full delegated business, that's when correspondent lender completes all the process by himself, and they just sell a closed file to the investor.
Hanna, that was pretty clear. The last question for you. What steps does the broker need to take to transition into a role of a lender?
So as I mentioned in the previous question, there are 3 different channels. So the way how to get there gonna depend on which kind of channel mortgage broker lender is going to choose to follow. So if the mortgage lender wants to become bigger company, want to take on bigger amount of operations, not only operations, but responsibility as well, and get a better pricing, of course, they need to go with a full DEL or non-delegated option. If they want to start small, I would recommend to start with mini correspondent channel. The first thing is to get warehouse line or enough of assets to be able to fund those loans that they're planning to close under correspondent channel. Once they get and feel comfortable with mini correspondent channel, they can expand the operations, hire disclosure team, compliance team, closing team to be able to fund and disclose those loans. They can either hire additional team members or they can use contractor company who help out with operations. And then once they feel already comfortable enough disclosing and working with the products of their investors, like in this case with A&D Mortgage, they can obviously move to the full DEL. That way they will have full responsibility for their loans, just be able to close them, to process them, to originate them, and sell closed loans to the investor, which is A&D Mortgage.
Guys, again, thank you so much for coming. As always, it's been a pleasure. Hanna, that was your first time. I hope you enjoyed the process of the show and, of course, the conversation. Thank you guys again.
Thank you.
Absolutely. Thanks, Nikita.
Thank you for joining us today on our YouTube channel for another insightful episode. We hope you enjoyed our discussion with Alex Suslov and Hanna Roslyk and found their expertise on securitization, broker-to-lender transition, and distribution channels valuable. Don't forget to hit that subscribe button and turn on notifications so you never miss an episode of A&D Digest. We're committed to bringing you the latest trends and expert insights in the world of finance and business, of course. If you have any questions of topics you'd like us to cover in the future episodes, please leave them in the comment section below. We'll love hearing from our viewers and engaging in meaningful discussions. Thank you once again for your support, and we'll see you next time on A&D Digest.